Every year, global financial networks manage to intercept less than 1% of illicit funds, even with billions of dollars poured into surveillance. This failure is built into the binary architecture of our settlement systems. When a transaction hits a decision gate, the code is limited to two choices: clear the funds or reject them. Financial risk exists as a continuous probability, creating a problem for transactions 65% likely to be safe. Because networks prioritize velocity, they lack a mechanism for hesitation. The system is mathematically forced to round that risk up to full approval to keep capital moving. This forced rounding creates the interdiction gap, a state where suspicious actions are approved simply because the system cannot account for ambiguity in real time. Current markets interpret this unverified speed as efficiency. They price the immediate cost of clearing these transactions at near zero. This creates a false economy. Approving unverified funds doesn't remove the risk. It transforms it into a delayed liability for the institution. Every transaction carries an invisible variable, probabilistic liability. This represents the total weight of regulatory fines and systemic damage that will be realized years after the funds have settled. Unverified speed is a ticking liability. Eventually, the delayed costs of money laundering and fraud catch up to the institutions that processed them. Ternary Logic addresses this by introducing a mandatory third state into the decision architecture. When the system detects incomplete data or suspicious counterparty behavior, it refuses to choose between clearing and rejecting. Instead, it forces a pause. This is the sacred zero. Under the mandate of no log, no action, the system is computationally unable to proceed until it generates a secure record of why it hesitated. Market participants often argue that a structural break will destroy capital velocity and degrade the efficiency of global markets. This concern assumes that all friction is waste, rather than a necessary component of systemic integrity. The epistemic hold converts unbounded probabilistic risk into a finite, measurable delay. The architecture achieves this by separating the speed of the transaction from the speed of the record-keeping. Using this dual-lane approach, the system completes the mandatory verification cycle in under 300 milliseconds. This sub-second hesitation is enough to neutralize layering tactics, where money launderers rely on moving funds faster than a traditional audit can follow. Modern markets can price a predictable 300 millisecond latency into their contracts. They cannot price the retroactive discovery of criminal facilitation. Accepting a fraction of a second of latency acts as a direct insurance policy against the multi-billion-dollar collapses that follow unmanaged risk. By trading unpredictable liability for measurable latency, the epistemic hold refines capital into a more stable asset class, higher integrity liquidity. This refined capital is structurally protected from the intense audits and severe enforcement actions that target unverified funds. Institutions running on Ternary 3, this verifiable reduction in risk allows banks to hold lower capital reserves, freeing up money for more productive use. The ability to hesitate makes these institutions more resilient and ultimately more profitable. In a world optimized for speed, traditional systems treat hesitation as an operational failure. Ternary Logic treats it as a design requirement. An effective system knows when it has not yet earned the right to make a decision. It prioritizes evidence over blind confidence. This reflects the architecture's original ethical framework, teaching machines to recognize the weight of the actions they perform. The capacity to pause ensures automated systems do not outrun our ability to verify their legitimacy. The epistemic hold provides the architectural proof that wisdom is still worth waiting for.